Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Getting back to earnings, Intel, our good friends out there in Southern California and out in the Valley, they reported some pretty darn good numbers and the stock's rallying. And I was just looking at Intel as a stock, and I guess when the government invests in you and NVIDIA invests in you, that's a pretty good sign of support. And the stock is up about 0.7% today, but it's up 92% year to date. Kunjan Sobhani, he follows Intel. He's a senior analyst. He covers the semis for Bloomberg Intelligence. He's based out there in our San Francisco office. Have you been to our San Francisco office?
I have. Beautiful.
It is awesome.
Yeah.
Pier 6, I think, or Pier 3. I can't remember which one it is, but it's awesome out there, right out into the bay. It's very cool. Kunjan, talk to us about Intel here. What's happening with their business?
Yeah, I mean, look, the results yesterday sort of seemed a start of a turnaround for us. Fundamentally, the stock rally you mentioned over the last few months has not been driven by any fundamental improvements. It was all purely driven by the deals that the three deals, the US government, NVIDIA, and the SoftBank deal, which all together brought in somewhere between $16 to $18 billion to them. That brings in long-term secular tailwinds, or not secular, but strategic tailwinds, but doesn't do anything to improve the near-term fundamental businesses and address the challenges. However, the results yesterday showed a step in the right direction where improving the demand for their AI PC and the server CPU products improved, which we have been wanting to see for a while. There were some structural changes that they're doing, which will help with gross profit improvement, gross profit dollar improvement going forward, even though the gross margin will still have headwinds next year. But we like the structural changes they are doing, bringing more wafers into Intel, ramping up the Arizona foundry with their newest Intel 18A node, which just has better cost structure than any other sites that they have. So they're doing many steps in the right direction, improving OpEx discipline as well. So all of that seems to be a start of a good turnaround, and there's still a long way to go.
Yeah.
Execution still needs to be done for many quarters, but this is the good news.
I'm so glad you brought up the investments from the U.S. government, NVIDIA, and SoftBank as something that helps certainly shore up the balance sheet. But how does it translate into operational gains? I mean, do customers decide to buy Intel's chips in meaningful volumes as a result?
I mean, not directly, not implicitly. The deals don't come with that, but there is some indirect influence, right? Or you might want to call it a validity that now, the risk of liquidity risk with Intel, which was there until a few quarters ago, the risk of sort of failing, the foundry business failing or not investing goes away. So big customers would gain some trust, right? That when you have backing of such key players in the industry, they must believe in you.
So, Kunjan, talk about the competitive environment here. So, Intel's made, some nice inroads here, but there's a lot of competition out there in their chip fab business. Talk to us about the competitive landscape.
Yeah, I mean, the competition for them, both on the foundry side and the product side, is intense. Frankly speaking, they have really missed out on the AI accelerator and the really AI in the data center ramp, which all of their peers like NVIDIA, AMD are enjoying. So they're playing catch up when it comes to most areas. The second issue in competition has been that they've been losing share significantly in the data center side. Again, this is the most profitable, highest spend side. This is where you really don't want to lose share. But slowly we have seen the share loss pace reduce. Almost staying share loss steady quarter over quarter. So now they need to work on improving, which the changes that they're doing going forward, which is moving the capacity to serve the data center customers at the expense of low-end PC customers, we think is the right step to, you don't want to lose share in that market anymore.
Right. So how different is Lip-Bu Tan, the CEO's strategy, versus Pat Gelsinger, his predecessor, who was let go? Is there a meaningful difference?
There's a huge difference, I think, from a personality, communication, strategy perspective. It's the two opposite ends. Lip-Bu seems to be more practical, sort of under promising and over delivering, which usually the street likes. Pat, on the other hand, was visionary, but was trying to get to the stars before focusing on the moon. So very different styles. Lip-Bu has done a lot of cultural changes, significant restructure in middle management. Getting everyone back to the office, which he really believes will bring significant culture and working changes. So a lot of different opinions, different styles. It's too soon to say which style is going to win, but at least we are seeing some good proof points of the new culture shift.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's talk about the auto business here. Ford. Holy cow, they had some good numbers. And I think the automakers are kind of saying we're focusing on the units, the models that make us a lot of money.
And they're not EVs.
No, they're not. They're kind of dialing back that rhetoric a little bit in response to, I guess, what they're seeing in the market. Craig Trudell, he's a Bloomberg Global Autos Editor. Craig, talk to us about Ford. They had some good numbers, but I'm also seeing some layoff discussion out there. Talk to us about Detroit. What's happening?
Yeah, it's been quite a week. It's hard to parse because you're seeing GM and Ford have these, strong earnings reports, huge moves in the stock. President Trump is taking victory laps over this on Truth Social, and yet this morning our colleague David Welch in Detroit had the scoop that GM is laying off hundreds of workers. So you have this situation where, as you say, the amount of sales these companies are pulling off with full-size SUVs, the Ford Expeditions, the Chevy Tahoes, those sorts of vehicles are really hot, and in some cases, as good as these companies have seen in something on the order of 2 decades, and yet also with that, real cost issues in terms of tariffs. I think maybe not the worst case scenario that they were concerned about months ago, but absolutely those were still headwinds. I think there is a concerted effort on the part of these two companies, however, to sort of really thank Trump for these sort of incremental bits of relief that he's taken off from of the measures that were put in place earlier this year.
Is that part of it done? Is that part of the story over, or are they still working to kind of continue to whittle away at some of the costs imposed by the president's policies?
I think it's still very much a live issue, and interestingly, some of the attempts to sort of curry favor with the White House seems to be around actually sort of applauding his move to put new tariffs in place on medium and heavy trucks. And the reason that they are appreciating that is because their rival Stellantis makes big Ram pickups down in Mexico. So it's a case of actually 2 players in Detroit kind of ganging up on the third and sort of praising Trump. And I think that was one of the interesting storylines out of last night's earnings, that Ford sees sort of some incremental opportunity to take advantage of the fact that one of their big competitors now faces much more of a tariff bill on those larger pickups that are made down in Mexico.
Craig, reading between the lines from the GM release and then the Ford results, it feels like these companies are stepping back on the margin from EVs and EV investments, and that seems to be one of the things that the street is applauding here. How do you read it?
Yeah, I think it's a little different across these two companies, where you have GM is much further along, I would say, in standing up battery capacity, standing up EV capacity as well. So they, I would say, on the other hand, have kind of on one hand have more EV potential and more battery potential to work with, and haven't quite sort of cut to the bone in terms of what they have to offer. And yet I would say, it's also been the case that, it's fair to look at sort of what they've managed in terms of how many EVs they're selling, and fair to say that it's been a real disappointment. We've not seen the ramp up in demand that was hoped for, even in the times when we were able to take advantage of $7,500 federal tax credits. As we know, that those days are now gone, and so you're seeing GM cut back. I think Ford's cutting back sort of predated some of these policy changes, and it's more to do with the fact that they've just been losing so much money on that side of the business, and have a little bit less to work with in terms of progress in scaling up the business and bringing down costs thanks to that scale.
Craig, did we learn anything from GM or Ford's financing divisions about consumers and how much debt they're able to take on? And I ask because, of course, we had the subprime lender PrimaLend enter bankruptcy this week. That followed Tricolor entering bankruptcy a few weeks ago. So there are a lot of questions about credit quality, particularly for low-end consumers or low-income consumers. Excuse me.
This absolutely came up, with Ford in particular, because Ford Motor Credit is a pretty, big part of that company's business. They did emphasize just sort of how small a sort of amount of exposure they have from a subprime perspective. I think that's not necessarily a shock, where you do have a situation where there's a lot of subprime lenders willing to sort of go after that business, and the captive lenders at Ford and GM tend not to play in that necessarily. I think there was a lot of concern years ago when GM, around the time that they were coming back from bankruptcy, acquired a subprime lender, and everybody said, "Hey, wait a minute here! Isn't this kind of what put GM in the ditch back in 2008, 2009?" But really, they've also turned GM Financial into a captive lender that does a lot of higher credit scores, and not necessarily targeting that subprime segment that everybody rightfully is concerned about, given the events of the last couple of months.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Back in the U.S., in the stock market, company news, Target cutting some people here. It's cutting some headcount in the corporate levels, in the salaried levels in corporate HQ. Let's see what's happening with Target and with the broader retail space in general. We can go to Jen Bartashus, Senior Retail Staples and Packaged Food Analyst for Bloomberg Intelligence. So, Jen, it looks like Target is announcing some corporate job cuts. What do you make of it here?
Yeah, hi, Paul. So when we look at Target, these are corporate jobs, as you said. It's about 1,800 in total, from 1,000 existing and 800 postings that haven't been filled. And really, this is, to us, signals that they're finally really looking at how to streamline the organization, tighten things up, and hopefully initiate change a little bit faster than they have to kind of get things back on track.
So is this an issue for the company, i.e., maybe they are a little bloated, maybe their profit margins aren't up to snuff? Is that something that's been identified?
Yeah. I think that the bloat is something that has been identified by the company, and they're not alone. If you think about, as we came out of the pandemic, a lot of companies introduced a lot more redundancy in their processes, in their things like that, just in order to make sure that they would have enough supply of goods for everybody. And as the overall supply chain is stabilized, now it's time to go back and trim that fat that they put on just after the pandemic. And again, Target's not alone. Walmart, earlier this year has also announced corporate head cuts. And so I think this is a normal course of business, but it's a good time for Target to do so.
So assuming it's a due course of business here, let's step back and take a look at their core fundamentals of the business, whether it's Target or Walmart here. As we go into this, holiday shopping season, what are the key drivers or the key levers that you're looking at to gauge success or, maybe some challenges?
Yeah, I think one of the things that needs to be kind of reiterated about Target's decision is that it doesn't impact the client-facing part of the business. And so that won't affect their seasonal hires. It won't affect their number of employees in stores. And when you're looking at broader retail coming into that holiday season, success is really going to hinge on making sure they have enough of the inventory in stock, that they've made good calls on what the items are that they're carrying, but also that customer support and experience. And so, those are the things that we're going to be looking for as we get closer to the holiday season. And we had Mattel and we had Hasbro report earlier this week, and they didn't have great results. And part of that is reading into toy demand for the holidays. And the orders that didn't actually materialize. So we'll be watching that very carefully when it comes to these retailers that really specialize in those kind of products for consumers around the holidays.
So what is Walmart, what is Target, what are they saying about the upcoming holiday season, which is such an important part for the overall retail chain?
Yeah, it is the most important part of the year for these companies. Both of these companies, as well as others like Costco, they all say that they're well positioned for the holidays. If you think about the procurement process, most of the orders for holiday goods were placed back in January or February. A lot of the goods started to arrive in July and August, so they should have their goods, here in the U.S. kind of ready to go. And so I think, but with the state of the consumer spending patterns in the U.S., although people are still spending money, they're still looking for value. So when we're looking forward to the holiday season, we think we're going to see much more spread out deals and people spending, on a spread out basis so that they don't get hit hard by big credit card bills in January. So watch for lots of small deals that kind of lead up into the holidays.
And will prices that we pay at the retail, at the Target level, at the Walmart level, are they going to be influenced by tariffs, do we think?
I think there will be certain categories that will be influenced by tariffs, and so all the retailers are saying they're using price increases as the last possible resort. And I think actually one of the interesting things is that when they talk about pushing back on suppliers or sharing the cost with suppliers, some of the commentary that we heard this week from Mattel and Hasbro sort of illustrate that there were lower orders. There's less expectation for quick refills. So it'll be interesting to see where that how effective those companies are at negotiating other ways to manage tariffs before they put price increases in. But in some areas, it's going to be impossible not to pass something through.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.